Stock exchanges provide an important source of funding for capital investment to develop a modern capital structure that someone must invest in buying. When a production company forms or tries to expand, it needs money to invest in capital, just like labor or other supplies. It can be possible to raise money by selling new shares of stock in a stock exchange. Each share of stock indicates part of the corporation's future profits for the owner of the share. So this is how a financial market can connect investors with those who has a need for capital. Stock trading determines who manages companies. If a company is managed well, its stockholders will earn high dividend on the price of their stock. If company management runs a company badly, the price of company's stock will fall. It would be easy for new investors to buy up shares of the stock and replace the management when a corporation's stock price falls dramatically. This is how stock exchanges get rid of incompetent corporate executives. Stock exchanges help developing countries to avoid waste from incompetent management. Stock exchanges play a significantly important role in developing countries. Capital formation is one of the major challenges that developing countries face. Like capital consists of equipment and machinery used to make consumer goods. When we look into the development of industrial Western Europe and North America, we can see the importance of the stock exchanges in economical improvement of these countries. The London Stock Exchange, for instance, emerged in the 18th century, or the Amsterdam stock market, which emerged in the 17th century. These stock exchanges were informal and simple. With the passage of time, these early stock exchanges developed into sophisticated institutions with formal rules. Eventually, stock exchanges in major cities began to direct capital investment throughout the West and in parts of Asia. For example, Belgium developed rapidly during the 19th century. The statistical studies indicate that the economic development of Belgium was driven by the development of Belgian financial markets, including the Brussels Stock Exchange. Financial development in Belgium began with the country's independence in 1830 and was accelerated by the liberalization of the Belgian stock market in 1867. This pattern was paralleled in many nations. Statistical studies show that well-developed stock exchanges have enhanced long-run economic growth, increased capital investment, and raised productivity throughout the industrialized world. In this part of the video, I tried to include some information about the Turkish stock exchange as an example. The Borsa Istanbul is the sole exchange entity of Turkey, combining the former Istanbul Stock Exchange. It was established as an incorporated company with a founding capital of $423,234,000. The new capital market law approval in December 2012 has been an important step for financial markets in Turkey. With this new law, Istanbul Stock Exchange merged with Istanbul Gold Exchange and Turkish Derivatives Exchange to form Borsa Istanbul as a joint stock company. The modern Turkish financial markets seem very young, but history of financial markets comes from the 19th century. The government debt instrument was first issued to finance the expenses of Crimean War in 1856. Afterwards, capital markets began to be formed in Istanbul. Since then, capital markets in Turkey continued to function with different names and under different capital market law establishments through the proclamation of the Republic in 1923 and after that. As mentioned in a guideline by Borsa Istanbul, Turkish capital markets offer advanced intermediary services such as research, investment consultancy and portfolio management, clearing and settlement in accordance with international standards, online, real-time data dissemination including market-by-price data. So the stock market's role in important changes in corporate governance could be enormously helpful to economic growth. Though the real question is what can be the appropriate regulatory regime for developing a country's security markets. Without an effective regulation, international investors will not have the confidence to commit their resources to developing country markets. Most importantly, Good management skills is required in developing countries to make an optimal use of those resources. So that's it for today's video. Thanks for watching. I hope you liked the video. Please make sure to subscribe to my YouTube channel and stay tuned until the next time.